Welcome to Global Economic Press, where we deliver trusted global finance and economic news, analysis, and reports, empowering leaders and investors with reliable, timely insights. I'm your host, Alex Brady. In today's episode, we delve into the recent market analysis released by Rotbart Co, which examines the intriguing dynamics behind gold's unexpected decline amid the ongoing conflict between the United States and Iran. Join us as we explore the factors influencing gold prices, the impact of geopolitical tensions, and the strategic considerations for investors in these uncertain times. Rotbart Company, an international precious metals consultancy specializing in the acquisition, secure storage, and structuring of physical bullion, releases a market analysis examining why spot gold fell about 2.6% in the week to 17 July during the conflict between the United States and Iran. The analysis notes that spot gold briefly traded below 4,000 United States dollars an ounce, its lowest level since first phone July, even as Brent crude rose roughly 16% over the same 5 sessions. Rotbart Company explains that higher oil and shipping costs can feed inflation expectations, support higher interest rate expectations, and increase the cost of holding non-yielding assets such as gold. The release also reviews physical market conditions in Singapore and Hong Kong and discusses allocated precious metal ownership and insured transfers between vaults. Few expect that from a war week. Over the same 5 sessions, Brent crude rose roughly 16% as strikes near the Strait of Hormuz restricted oil flows. Futures markets priced a roughly 58% chance of a United States interest rate increase in September, according to CME FedWatch data. Why conflict pushed gold down, not up? The same event is pulling gold in opposite directions. Geopolitical risk normally lifts demand for defensive assets. But this conflict has also raised the price of oil and shipping. Higher energy costs feed into inflation. If inflation persists, interest rates tend to rise, and bond yields rise with them. That matters because gold pays no income. When cash and bonds yield more, the cost of holding gold goes up. Expectations of higher United States rates have also supported the United States dollar, which makes gold dearer for buyers in other currencies. This week, those forces appear to have outweighed gold's immediate defensive support. War does not automatically lift gold, and it never has, said Joshua Rotbart, founder of Rotbart Co. Markets weigh several forces at once. This week, the inflation and interest rate effects of higher oil prices carried more weight than the instinct to seek shelter. That is normal market behavior, not a sign that gold has stopped serving a defensive role. The view from Singapore and Hong Kong, Asia's physical hubs, have stayed calm. Gold in Singapore changed hands between a 1 United States dollar discount and a 2 United States dollars premium to global spot, and in Hong Kong between a 1 United States dollar discount and a 1.7 United States dollars premium. Ranges that narrow point to steady, price-sensitive buying, not a scramble for metal. Hong Kong dealers had flagged 4,000 United States dollars as strong support, with buying interest likely below it. The level gave way briefly on Friday. China's central bank added 14.93 tons of gold in June and helped stabilize prices with a 20th consecutive month of purchases. Short-term price. Long-term decision. The contrast is the lesson. Wholesale prices moved on rates and the dollar. Asia's physical buyers kept to their own schedule. Geopolitical developments may push private investors to diversify into gold, whose share of private portfolios still remains historically low. There is a difference between speculating gold around headlines and owning allocated precious metal as a generational wealth strategy, Rotbart said. The first is a position on next week's price. The second is about how your wealth is structured, held, and protected across decades and jurisdictions. One difficult week for the spot price changes nothing about the second. For metal concentrated in one location, especially near the conflict, allocated ownership has a practical advantage. It can be moved. Rotbart Company arranges insured precious metals transfers between its vaults worldwide, including Singapore and Hong Kong. In a week like this, the useful question is not where the price closes on Friday, Rotbart said. It is where your metal sits and whether you can move out of harm's way when circumstances change. Allocated storage in stable jurisdictions with insured transfer between vaults is a secure and pragmatic answer. It turns a geopolitical headline into a logistical matter you have already planned for.